Hey there, Marcus here, Construction Loan Channel, the place where builder spec financing thrives and investor construction programs are our priority. If you're watching this, you've probably done what most real estate investors do. You've scrolled through listing sites, crunched numbers on existing rental properties, and realized something's not adding up. The prices are inflated, the properties need work, the cash flow is marginal. Sound familiar?
It's frustrating, right? You've got capital, you've got ambition, but existing properties in your market feel overpriced and overcompeted for. There's got to be a better way.
There is, and that's exactly why Tyler and I are here today. We're breaking down interim construction loans, the financing tool that lets investors and builders stop chasing overpriced existing properties and start building new assets from the ground up.
In the next few minutes, we're going to show you how interim construction financing reshapes your entire real estate strategy. Real numbers, real examples, real paths to building wealth that actually makes sense.
So stick around, this is the blueprint. Let's start with the reality most investors face. You're looking at properties on the market. Everything's already been competed for by 30 other investors. Prices reflect that competition. They don't reflect actual cash flow potential.
Exactly. And here's what nobody tells you. When you buy existing, you're not just buying the building. You're buying the previous owner's problems and headaches, hidden structural issues, systems that are about to fail, deferred maintenance that you'll only discover after closing. You end up buying a whack-a-mole maintenance nightmare.
I worked with an investor last year who bought a duplex listed at $420,000. He thought he'd found a deal. Post-inspection, $28,000 in immediate repairs, roof in 5 years, furnace in 3. His cash flow projections got crushed before he ever collected a rent check.
And that's the standard experience. You factor in a maintenance reserve, you budget for vacancy. Suddenly your 7% cap rate becomes a 5% cap rate or less. Your expected cash flow evaporates.
But building new, that calculation changes completely. You control the basis, you build at cost. And here's the key. New properties attract higher quality tenants who will pay premium rent for modern systems and zero surprise repair calls. All your appliances are in warranty.
We're talking real differences. A new duplex in the same market might rent for $2,400 per unit. The existing property next door, $2,000 because it's 20 years old. That $400 monthly difference is $4,800 annually per unit. That compounds.
So what's an interim construction loan, and why does it matter for your investment strategy? An interim construction loan, or ICL, is financing specifically designed for ground-up construction. Unlike traditional mortgages, these loans are appraised before building starts, so you know you are not overbuilding for the location. They fund in draws as construction progresses. This matters because you're not carrying dead money.
Think of it this way. With a traditional construction loan, you might borrow the full amount at closing. You're paying interest on every dollar immediately, even though only a percentage is deployed. With an interim construction loan, you borrow as you build. We verify progress. Money releases accordingly. Your debt service stays proportional to actual construction to that point.
For investors managing multiple properties, this is capital efficiency at its highest level. You're not overpaying for money you haven't deployed yet.
And here's the really important part for anyone new to this: interim construction loans work with the equity you already have. If you own land, the equity counts toward your down payment. You don't liquidate other assets. You don't drain your reserves. You leverage what you already own.
I worked with an investor who owned a piece of land worth $200,000. No mortgage. He wanted to build a duplex. Total construction cost, $350,000. Post-construction value, $550,000. His down payment requirement, probably around $100,000 to $125,000. But because his land already had $200,000 in equity, he only needed to bring $10,000 to $15,000 cash out of pocket, and he could have rolled that in if he chose to. Same deal, dramatically less capital required.
That's the game changer. Most investors don't realize they can use their existing equity this way. They think they need to sell property or tap investment accounts. Nope. Your land equity works.
Loan amounts generally available starting at $200,000 and up, which means investors with smaller projects, single-family rentals, duplexes, triplexes, can access financing that was previously only available to large-scale developers.
Let's talk about where investors get excited, the actual cash flow numbers.
Scenario 1. You buy an existing duplex. Purchase price, $440,000. Acquisition costs and immediate repairs, $25,000. Total basis, $465,000.
Monthly rent per unit, $2,000. 2 units means $4,000 gross monthly income.
Subtract property taxes, insurance, vacancy reserve, maintenance reserve, property management. Your net operating income drops to approximately $2,400 monthly. That's a 6.2% cap rate on your invested capital.
Now, scenario 2. You build that same duplex from the ground up. Construction cost, $350,000. Post-construction appraised value, $520,000.
Your interim construction loan covers most of the construction cost. Your down payment is minimal, especially with land equity factored in. Once complete, that property appraises at $520,000.
But here's the magic. Your basis is still the $350,000 construction cost. You've got $170,000 in equity before you ever collect a rent check.
Monthly rent per unit, $2,250. The new property commands a premium because it's new. Buyers and renters pay more for new. 2 units equals $4,500 gross monthly.
Your maintenance reserve drops because systems are brand new with warranties. Your vacancy risk drops because the property is attractive. Your net operating income hits approximately $2,800 monthly. That's an 8.7% cap rate.
That's not a marginal difference. That's a 40% improvement in cash flow. That's the difference between a property that's mediocre and a property that's powering your portfolio forward.
And we haven't even talked about depreciation yet.
Here's where things get interesting and why your CPA needs to be part of this conversation. New construction properties qualify for depreciation schedules that existing properties simply don't. The IRS allows for cost segregation on newly built properties in ways that create significant tax advantages.
Without getting too deep into tax weeds, the simple version is this. You're going to have substantial depreciation deductions that offset your rental income. That depreciation doesn't cost you actual cash. It's a paper deduction, but it reduces your taxable income dramatically. I had a client, David, built a duplex, $350,000 construction cost. Depreciation deduction in year 1, approximately $13,000. That wasn't cash out of his pocket. That was just how the IRS values the asset's decline over time. That $13,000 in annual depreciation means $13,000 in rental income that's not taxed. Over a 10-year hold, that's $130,000 in tax savings. That's capital staying in David's pocket that he can redeploy into his next project. For investors building multiple properties, this compounds. You're optimizing your entire tax profile simultaneously. That's not dodgy tax theory. That's using the tax code the way it's written, strategically. So when you compare building new to buying existing, you're not just looking at cash flow. You're looking at after-tax returns. Building new wins on both fronts. If you're serious about wealth building through real estate, call us at 888-857-8041. Let's discuss your specific situation and show you exactly how depreciation works in your favor.
Tyler, most contractors are contract dependent. They build per contract. They're essentially subcontractors to retail home buyers or commercial developers. The work is consistent, the risk is low, the upside is capped. You're trading your time and expertise for a fixed contract price. But what if you built for profit instead? Spec building for investors is the bridge strategy. You build. You sell to an investor who understands real estate. The transaction moves faster. There's no home buyer financing contingency, no appraisal surprises, no negotiation theater.
For builders with good project management and a solid track record, spec building is a profit multiplier. You maintain your construction margins, but you also capture developer margins. On a duplex build costing $350,000, your contractor margin might be $25,000. But if you're the developer builder, you might capture an additional $30,000 to $50,000 as development profit when you sell to an investor. And here's the beautiful part. Interim construction loans make spec building infinitely more accessible. You're not waiting for home buyers to jump through mortgage hoops. You're not financing deals yourself. We provide you the interim construction financing. You build and exit. We provide your investor the financing to pay off your loan and off to the next project. You get accurate communication since both your interim construction financing and your investor buyer financing are handled all under one roof. This is how contracting businesses scale into development companies. You're not trying to accumulate properties, you're building efficient assets and moving capital. In 18 months, you've completed 3 spec projects. Your profit compounds, your reputation grows, your next project gets easier funding. If you're a contractor considering this pivot and you want to understand how interim construction loans make this feasible, call us at 888-857-8041. We work with builders on this transition constantly into the new alternative housing types.
What do you mean?
Barn dominiums, modular construction, alternative housing types, these aren't niche anymore. They're legitimate investment vehicles with exceptional economics.
Walk me through the math.
A traditional stick-built duplex might cost $350,000. A barn dominium build on acreage, similar square footage, similar quality, $280,000 to $300,000 build cost. Same quality materials. Better efficiency. Different aesthetic. Post-construction value? The barn-do might appraise higher because the market values that lifestyle. And here's the tenant market. Barn dominiums attract a specific demographic willing to pay premium rent for that lifestyle. Your tenant quality often exceeds traditional rentals. Your lease terms are longer, your maintenance costs are lower, so your basis is lower, your rental command is higher, and your tenant retention improves. That's a triple win. And interim construction loans work equally well across these building types. Whether you're building traditional duplexes or alternative housing, the financing structure adapts. This is where investors with creative thinking separate themselves from the crowd. You're not competing against 47 other investors for the same tired duplex on Main Street. You're building a specialty asset in a specialty market. Lower competition, better economics. If you're considering alternative builds and wondering about financing, call us at 888-857-8041. Let's discuss your specific project type.
Let's walk through the actual process from concept to cash flow. This demystifies what actually happens. Step 1. You identify your target: single-family rental, duplex, barn dominium, modular multi-unit. You define your target market, you run comps on rental rates, and you calculate expected cash flow. Step 2. Land acquisition or land equity verification. Do you already own land? Fantastic. That equity counts. Are you purchasing land? The acquisition happens before construction financing. We need a clear chain of title. Step 3. Construction planning. You need construction drawings. You need a detailed cost estimate. This is where a good general contractor matters. We, as your lender, will review these documents and validate the project's scope and budget. Step 4. Interim construction loan application. You bring your land, your construction plans, your down payment, and your business plan to us. We'll explain loan structure, term options, and funding process. Step 5. Closing and construction begins. Once the loan closes, you've got the capital you need to build. We fund via draws. You hit construction milestones. We order the inspector to verify completion. Next draw releases. Step 6. Permanent financing transition. Your interim construction loan refinances into long-term investment property financing if you are going to hold it, or we close the loan for your investor buyer and your cash is freed up and profits in your bank account. You now have a fully built, fully occupied, or ready to occupy rental property carrying permanent financing. Your cash flow is locked. Your depreciation schedule is active. Your wealth-building engine starts humming. Wash, rinse, repeat. That entire process, from land to cash flow, Takes 6 to 12 months depending on your build timeline and market conditions. That's fast, that's achievable, that's repeatable. And the best part, you can run multiple projects simultaneously. You don't have to wait for one to finish before starting the next. That's portfolio scaling.
In the years I've been working with investors, certain mistakes repeat. Let me call out the big ones so you don't repeat them. Go ahead.
Mistake number 1. Underestimating construction costs. Investors bring a budget. Halfway through the project, they realize estimates didn't account for site conditions, permit delays, material escalation. Suddenly, they're short cash. The fix work with an experienced general contractor who's done similar projects. They know the contingencies, they know the hidden costs. Their estimate is realistic and they'll build in some contingencies. Mistake number 2, poor project management during construction. Draws are released up to twice a month. If the contractor isn't hitting milestones, draws get delayed. Cash flow gets tight. Costs escalate. Suddenly, you're behind schedule and over budget. The fix: hire a construction manager or an experienced GC who'll stay on top of timelines and quality. Project management is the job that pays for itself. Mistake number 3, miscalculating rental demand and tenant pricing. Investors build but can't achieve the rental rates they projected. Cash flow doesn't hit targets. The fix: run comps obsessively. Talk to property managers in your market. Understand what renters actually pay. Build in that actual market rate, not your best case scenario. Mistake number 4, forgetting about the permanent financing bridge. Your interim loan works great during construction, but if you can't transition to permanent financing or sell to your investor because we can't approve permanent terms or your investor buyer, you're stuck. The fix: discuss the permanent financing exit strategy with us up front. Make sure that exit is realistic. You're building not just for construction, you're building for long-term financing. This is why we pre-qualify your investor and buyer, or you, to transition the property to an investment hold property before you even close on the construction loan. Avoid these mistakes, and you're in the top percentile of real estate investors. You'll have projects that actually perform. Let's zoom out and talk about capital efficiency across an entire investment portfolio. Capital efficiency is the ratio of return to deployed capital. It's what separates wealthy investors from those who are always chasing the next deal. When you build new via interim construction loans, you're deploying the minimum capital necessary to capture maximum returns. Your equity isn't locked into one asset. It's working efficiently across multiple projects simultaneously, maximizing your leverage. Let's say you've got $500,000 in available capital. Scenario A: you buy existing properties. You deploy that $500,000 across 4 properties at 25% down. Your total portfolio value, $2 million. Your cap rate across the portfolio, 6%. Scenario B: you build new via interim construction loans with that same $500,000. Your down payments are lower because land equity and lower construction basis require less capital. You build 6 properties instead of 4. Your total portfolio value, $3.5 million. Your average cap rate, 8%. Your capital has multiplied in impact. You've built more assets with better returns using the same initial capital. That's capital efficiency. That's portfolio scaling. That's the difference between investing and building wealth. If you want to learn more about deploying your capital more efficiently through interim construction loans, call us at 888-857-8041. Let's talk portfolio strategy. Here's the reality you need to understand. Market conditions are temporary. Interest rates shift. Property valuations fluctuate. Rental demand changes. Right now, today, new construction offers distinct advantages. Existing property valuations have inflated beyond logical cash flow models. Building new gives you control. You're not competing against 40 other investors for the same property. Good rental properties are in short supply. Additionally, tenant preferences are shifting toward modern properties. New construction rents 15 to 25% higher than comparable existing properties in most markets. That's your margin. That's your competitive advantage. This window doesn't stay open indefinitely. Markets cycle. Conditions change. Build when the math makes sense. That time is now. If you're sitting on capital wondering how to leverage and deploy it, if you've been frustrated with existing property returns, if you're ready to build something instead of buying something, now is the moment to act. This strategy isn't new. Investors have been executing it successfully for decades. The interim construction loan simply removes the financing complexity that previously made it inaccessible to smaller investors. So here's what we want you to do right now. You've got two options. Option 1. Keep scrolling through listing sites, fighting over the same tired properties with 40 other investors. Keep watching your cash flow get squeezed by maintenance costs and deferred decision-making. Option 2. Pick up the phone and have a real conversation with our team about your specific situation. Call us at 888-857-8041. Tell us about your investment goals. Tell us about your available capital. Tell us about your target property type. We'll walk you through exactly how interim construction loans can reshape your strategy. We work with investors and builders every single day who are ready to move beyond traditional financing constraints. We understand the obstacles. We know how to structure deals that actually work. Your blueprint exists, your capital exists. What's missing is the financing structure that makes new construction accessible. Let's build this together. Call 888-857-8041. We're ready to talk. For more helpful videos on how we can help you achieve your dream home, make sure to like, share, and subscribe. Also, put your questions below in the comment section. Don't forget to call us at 888-857-8041. If you found this video helpful, make sure to like, share, and subscribe for more expert insights on home building, real estate, and financing. Comment below with your questions or experiences with construction loans.